Welcome to the Commercial Real Estate Podcast, powered by First National. I am Adam Powadiuk, sitting here with Aaron Cameron, and day 2 of the Toronto Real Estate Forum. This is part of our speaker video series, sponsored by Glass Lake Funding, and we thank them for that. We've got an interesting episode coming up. We've got Sal Iacono, President and CEO of Cadillac Fairview, is going to spend some time with us talking about real estate at a very macro level, which would make sense given his position in the industry. Sal, welcome.
Well, thank you very much for the invitation. I'm looking forward to this.
So we're going to get into, I think we're going to virtually all the asset classes, development, portfolio reallocation, all that great stuff about managing multi-billion-dollar portfolios. But before we do that, can we get it, some of the background on how you got to where you are today, what your career arc has been, and, of course, we'll get into the Cadillac platform as well.
Sure. Well, early on, I actually started as a telecommunications engineer. And to be honest with you, I didn't like it as a profession. I'd always wanted to get into the real estate business because my family used to own apartment buildings in Montreal. And I was fortunate enough, after I got back to business school, that I was hired by Trizec back in the late 80s in Montreal. And I started off in the office business in various capacities, from a construction management perspective and analyst roles and so on. And then that migrated into a role at Marathon Realty, which was then a wholly owned real estate subsidiary of Canadian Pacific Limited. And ultimately, Marathon Realty became Oxford. When it did become Oxford, I left, and I migrated into a series of called self-employed positions as property manager, asset manager, and a co-owner of an asset management firm that focused on all asset classes across Canada, and we had a couple of sources of U.S.-based funding, in that regard. I did that till about 2002. We had some hits and misses in terms of...
Learned a lot, though.
Learned a lot, but, the one thing I did learn, which is also a lesson for all of us today on the office side of the business, is because of the dot-com meltdown, I remember, we had a substantial office portfolio, and in March of 2000, I literally lost half of my leasing. And that was a bit of a aha moment in terms of, riding a rocket until it's not a rocket no more. And, I felt sort of coming off of COVID that, that happened in similar regards with a couple of our asset classes. But just go back to, the origin story. I did go back to Montreal because I continued to live in Montreal throughout the whole time, even though I was in Toronto, based in Toronto during the week. And I started doing residential development from my own account. But I also continued to love commercial real estate, office, industrial, and retail. And I did a lot of consulting work for a lot of different companies who had commercial assets in Quebec. And one of my clients was Cadillac Fairview. And on behalf of Cadillac Fairview, I did a large land assembly in downtown Montreal around the Bell Center. And the thesis behind that was basically trying to put forward a mixed-use development that would be in partnership with the Montreal Canadiens and use sports branding as the underpinning or the platform to be able to market that project. So ultimately, in 2008, I actually joined Cadillac Fairview, and we went ahead with the Tour de Canadien, or the Montreal Canadiens towers, which Cadillac Fairview has developed 3 towers with some other partners, totaling in excess of 1,600 units. And they were all called the Montreal Canadiens Tower 1, 2, and 3.
Are you a Habs fan?
Just a bit.
So that must have been an exciting element of the project then,
Yeah. And we also developed a 500,000 square foot office building called Deloitte Tower. And we're now currently, just about to deliver a 500 unit purpose-built rental project called Le Carré Windsor in a couple of months. So it's been an incredible...
Oh, that same piece of land.
On those
that area.
Various, assembled sites. And during that time, I not only worked on all of these developments, but because of my prior background, as these opportunities came up within Cadillac Fairview, I did investment management and property management and lots of asset management, and culminating in my current role for the last couple of years as president and CEO. So, if you do a little bit of everything at different times during this industry, during the cycles of whatever, is needed, then, it, at least in my case, gave me the opportunity to be able to be well-rounded enough to deal with a lot of different topics at different times.
So leaving telecom really paid off.
Leaving telecom really paid off.
What's the hardest part of your job today?
I think it's just simply navigating the unknowns. There used to be a time in this business where, to use Robert McNamara's phrasing, it's like, we're all prepared for the known unknowns. It's the unknown unknowns that you really have to worry about. So, pandemic, post-pandemic, it took a while for us to be able to repair a lot of things. And look, even 5 years after the pandemic started, the office business in Canada, and I would say more particular in Toronto, because it's not necessarily the same experience across the rest of the country. The rest of the country is okay, but in Toronto in particular, finally, we're starting to get some traction, certainly over the last 6 months, because of return to office policies from all the major financial institutions. It's taken 5 years for that. And I look at our retail business overall, it's like, it's rocking. Notwithstanding, HBC's failure, if we look at currently the productivity level in all of our small shop space, or CRU, and all of our enclosed shopping centers, and, quite frankly, we're the biggest operator of enclosed shopping centers in the country. And out of the top 25 in productivity, we own and operate 13 of them. But we are actually at a historic high productivity level in our shopping centers. And this is, in comparison to in the middle of COVID, when a lot of our malls across the country were shut down and we could not collect rent from all of our retailers, and there were a lot of retailers filing for bankruptcy, and there was a really...
Retail is dead. We said that so many times on the podcast during the pandemic.
Right. Well, it was an existential question. It's like, is it actually going to come back? Not only has it come back, but it's thriving. And it's one of the few asset classes that we have where we can count on pretty good internal growth on a go-forwards basis. It's hard work. You have to be good at it. You have to have great retailer relationships. It is not only real estate. It is an operating business, but nevertheless, it's a great asset. So we're happy to still be in it.
Is Eaton Center the most productive mall in the country?
No. I think the most productive mall in the country would be Yorkdale, followed by Pacific Center, which Cadillac Fairview does own and operate in Vancouver, followed by Toronto Eaton Center.
Okay. Next, we want to go into sort of investment thesis and just talk about, your strategies from a high level, and we'll get into more of the sort of the nuance on an asset by asset basis. Before we do that, maybe just set the table. Can you just describe quickly sort of the scale and scope of Cadillac Fairview's ownership?
Sure. We currently own or co-own, operate, manage about $27 billion Canadian of assets exclusively in Canada. Cadillac Fairview is a Canadian-only company since the beginning of 2024. And our shareholder, and we only have the one shareholder, which is Ontario Teachers Pension Plan, decided to restructure how it holds and operates its real estate globally. And they decided to make a change at the beginning of 2024, where basically all real estate that Cadillac Fairview used to own and operate outside of Canada now reports directly into Teachers through a global head of real estate. And Canada is its own separate operating company that is 100% owned by Teachers. So that's our scope of responsibilities. But nonetheless, it's a $27 billion Canadian portfolio, pretty big. Comprising of about 35 million square feet of primarily at this time retail and office space, basically split 1/3, 2/3 in terms of value, between retail being 2/3 and office being 1/3.
So during the pandemic, you were having some heartaches.
We were having kittens. Like, look, there were many phone calls with a lot of retailers who were just, literally besides themselves, because they just didn't know if they had a business to go back to, the next day. And, interestingly enough, during those really difficult, dark days, some of the best decisions were made. And we were able to assessed for ourselves at Cadillac Fairview that, look, no one's going to come away from this unscathed. We were looking at some of the experiences of our American counterparts and peers where, you can fall back on the legalese of the leases and say, notwithstanding a flood or pestilence or a pandemic or whatever else is happening, you got to pay me rent. I don't care where you get it from, but you got to pay me rent. Well, look, the approach that we took was we're going to work with our retailers. We're going to try and figure out a solution. No one's going to come away from this unscathed. And in being able to work with our retailers and vice versa, we came through that period of time with much better, much stronger relationships that actually served us and them really well for us to be able to bounce back even faster than everybody expected. Because, we worked together and everyone involved took a little bit more water in their wine, but it allowed everybody to reset the platform.
Yeah, well, and in today's environment, beds and sheds at the time had all the favor, but retail and office are now really right back into the conversation of attractive assets.
Well, on the office side during the pandemic, funnily enough, we were all concerned about everybody's working from home, but our office clients continued to pay rent. We collected 100% of the rent in our, and quite frankly, the biggest office portfolio in the country throughout the whole duration. What happened subsequently was, because of the habit and the behavior changes amongst employees and employers, the return to office didn't happen as quickly as expected. And because of that, there were decisions made with regards to at lease expiry. We're not going to renew, or we're not going to renew as much because we're going to be adopting this new mode of work. Well, that worked until it didn't work. And it didn't work until about 6 months ago when everybody decided, well, you know what makes most sense for our business is to actually have people come back to the office at least 3 or 4 days a week, which then, drove demand once again. And that's what we're seeing, the benefits of today. And the benefits certainly for an office landlord are important, but the benefits are even more important for the employer because, office space cost is a very small component of an employer's, cost model. It's how do you ensure that your employees are working productively, efficiently, that they're being mentored, that they're developing, that they've been given all the tools and atmosphere, space for them to continue to be successful so your company can continue to be really successful and improve profits and so on. So thankfully, that has onboarded into employers' thinking once again.
Do you talk about sort of experiential office, sort of as a tenant for your platform?
Yeah, look, and there's a lot of different definitions and so on. And I don't think there's a one size fits all solution to that because it depends on what kind of employer you are, the kinds of employees that you have, what generational representation you have in that. Are you in the suburbs? Are you downtown? How close to public transportation? Are you in New York City, or are you in Toronto or in Chicago? Because there's different market expectations and all those. At the basics of it, do you have access to good amenities like conference facilities, bike storage rooms, access to public transportation, restaurants, food courts, etc.? Well, then, the sky's the limit. You want to have a gym, either employer sponsored or landlord sponsored, or as a tenant, in terms of, with a wide array of services and activities available, libraries, sky decks,
it goes on with basketball courts in the lobby, right? It goes all over, right?
Yeah. But some of the things that we do sometimes are just the simple things that really drive an occupant affinity for the building. So, the office business is, there's a bifurcation, if I could describe it that way, between those who are in a position to decide whether to stay or do a deal in a specific building or not. But then there's the occupant experience. We believe very much that if you can make the occupant experience for the employees favorable enough and pleasant enough, that will filter up to those individuals who are on the management team who make those decisions to say, you know what, yeah, there could be maybe a different deal somewhere else, but our people really love it here, and we really care about our people, so we're going to choose to stay here. So we do a lot of activities in that regard to really focus on the occupants. We also focus on the relationships with the shooters who are the decision makers. Like, I don't want to leave any doubt in that regard, but we also focus on the occupants.
For the record, we're a tenant of Cadillac Fairview, and the puppies in the lobby are definitely a hit with our employees.
And I think Aaron might be one of the shooters who makes decisions in this context.
There you are. So look, the third Monday of January, right, is the most despondent day of the year for most Canadians. Like, everybody's visa comes in after the holidays. It's January. It's cold. It's gray. And we've got these incredible puppies that come into most of our office lobbies across the country. Like, how can you beat that?
Yeah. No, it's good. That's a good one. I mean, the lineup is always around the corner out the door just to go up, get licked by a puppy.
And what amazes me about that is that it cuts across the whole swath of people who are, occupants in our buildings, from the CEO down to, an admin assistant. Like, it's fine. You know what? There's a commonality there, and there's a feel-good story to it.
Who doesn't love puppies?
Who doesn't love puppies? Exactly.
You mentioned, I guess, your portfolio mix in COVID, and I know you've been repositioning it. So what is the end state? What's the perfect balance that you're trying to achieve before market conditions then dictate some new strategy? But what are you working towards now?
So, the perfect balance in any real estate portfolio really should be derived from who are you as an owner, right? What is your risk tolerance? Where do you want to be located geographically, and so on and so forth. So I can speak on behalf of Cadillac Fairview and my shareholder. So first off, our shareholder does write checks every month to retired teachers in Ontario. There's an actual cash out every month. And we provide some of that cash because of the nature of the industry that we're in, where we collect rent. I mean, our business is complicated at times, but it's simple most of the time. We collect rent, we pay bills, we drop it into a bank account, our shareholder takes it, and they pay pensions with it. Now, it sounds simple, it's very complicated, obviously, but that's what we do. So at the core of it, our mandate is to figure out, for the long haul, what are the best risk-adjusted returns that we can provide to our shareholder so that we can enable what their requirements are. And their requirements are to provide a good return for the teachers of Ontario and to also provide cash so that they can actually send out checks. So we were incredibly successful until the pandemic in that regard. However, the pandemic also showed us that being very overweight on retail and office, where you have really good internal growth metrics, also proved to be pretty tough in that context. So one of the things that we've been trying to do since, one of the things that we've been trying to do since is say, okay, you know what, how do we lessen our exposure in terms of equity on retail and office so that we can redeploy that money into multifamily and into industrial. And, one of the things that that we're going back to is, in the history of Cadillac Fairview, we were one of the biggest residential developers in the country, dating back to the 60s and 70s. So
the last boom, yeah.
Right. So we're just going back to, the roots of our legacy, and we're now going to be using the proceeds of some of these recent sales of our shopping centers and some office buildings. And we're starting to both develop apartment buildings and industrial. And we're also on the hunt for acquisitions in those two asset classes. And ideally, over time, and time is going to be years, because we're talking about shifting billions of dollars worth of equity. And it takes a while because Canada is only so big as a market. It will, we would like to be 20 to 30% in each one of those four asset classes, being retail, office, multifamily, and industrial.
There's some synergies here. Over the week here at the Real Estate Forum, we've had a handful of different conversations. One of them was just with a researcher at CMHC, and just talking about, the challenge we have with the housing crisis and what's going on with the apartment market. he had this perspective where he was really defining the crisis as three different crises. We've got a northern housing crisis, we've got a vulnerable individual crisis, which is sort of the social housing, and then there's sort of the missing middle sort of workforce housing crisis. And in that group would be firemen, police, paramedics, nurses, and teachers who really are having a hard time finding housing in a neighborhood next to the schools that they work in. So there's some synergy where you can actually start helping to help house the people that are benefiting ultimately from your shareholder.
Yeah, and look, a lot of those components that you're describing, but more particularly the middle component, because that's primarily
that's where you'd be focused.
That's where we'd be.
Well, that's where the private market has the biggest impact, right?
But that's usually part of the requirements in terms of entitlements and permitting in most of the projects that we're looking at, where they deem it to be, call it, an affordable component to the housing project that we're proposing, or that anybody proposes in those major markets. And that's what it's squarely, aimed at. In some cases, it makes sense. In some cases, it may make sense for the municipality, but it may not make sense for the pro forma. And that's where the difficulty lies in the development, world. And that's just one part or one component that may not help the pro forma. The other challenges in the residential industry in Canada generally, everybody talks about the same things, but they're worth repeating. Development charges, the length of time it takes for permitting and entitlement, because that adds a lot of interest costs to any developer's pro forma, because you have, it's borrowed money that's exposed to a project for way longer than it should be. The fact that municipalities are no longer in the business of, providing infrastructure and recovering it through property tax and expecting the developer to be able to put it on their pro forma. Community centers, the daycare spaces, parks, sewers, water supply, and so on. Like, those things cost money. And over the years, they've been offloaded to developers. And maybe, some level of government should be taking those on again. So there's a lot of things that still need to be corrected, and let's not go, and that's not even including sales taxes and what could be done with those. So there's certainly a lot of impediments right now.
Yeah,
just generally
feels like there's a lot of momentum for change. Whether that change actually occurs or not in a positive way will to be determined. But the narrative that the noise around that conversation has grown to a point that I've not seen before. And
what we're doing in terms of the multifamily projects that we've launched, 3 out of the 4 are adjacent to or part of our existing shopping centers. So, in our specific strategy, we're able to justify something a little bit better than most, simply because we get this virtuous circle by building multifamily on the parking lot of one of our, tier 1 shopping centers, where the shopping center is the amenity that those future residents are looking for, which is great. It'll allow us to lease out those buildings. Oh, and by the way, the retailers will now have at their door threshold a whole bunch of residents who have just moved in next door. And we're looking forward to continuing that in all of our malls. We've done that at Richmond's Shopping Center in Vancouver, where we delivered 1,000 condominium units, including an affordable housing component for local workers. We're doing the same thing in Carrefour Laval, that we're going to be delivering a project in 2027. We're doing the same thing at Rideau Center in downtown Ottawa, where we're delivering a project in about 6 months, in mid-26. So, and we're going to continue to look for these kinds of opportunities, because, our pro forma has helped along a little bit because of the benefits that we're going to get.
There's a lot of parking lot space that goes underutilized. How many units in total?
Currently under development, close to 1,600 units.
And which markets would you launch in going forward? I mean, we have talked about impediments, obviously, to development, but you are obviously still going ahead with projects despite some of the difficulties.
So not just projects, but we're also focusing our acquisition activities on, called 5 major markets, which includes Montreal, Ottawa, Toronto, Calgary, and Vancouver. And the reason why we're focusing on those is that's where we also have, amongst our biggest shopping centers and office buildings. So we already have a management team in place. And we look at those markets as being big enough for us to be able to actually grow into a critical mass where in the future we can, be able to actually conduct our own property management in those properties.
We're almost out of time, so I want to get to the last sort of topic, and I want to frame this as an opportunity because I think it really is. It's just the Hudson Bay bankruptcy created a lot of and this is what the opportunity for you guys to sort of rethink some of that space. I mean, to be fair, I live near a shopping center that you own that has a Hudson Bay in it, and we never went in there. No one ever seemed to be in there. It seemed to be kind of not really doing that great. And so I'm framing it this way. Like you've now been able to kind of take back a bunch of space to find new ways and creative ways to benefit the community that uses it, the tenants that are going to live in the apartment buildings nearby. So how does that exercise look like? I know it's been probably a creative process to figure out how to reposition that space.
Well, look, to be fair about this, Cadillac Fairview has become, I think, the world's expert in how to reposition department store boxes because HBC is just the last in a long line of starting with Eaton's and Target,
Nordstrom, I think,
and Sears and Nordstrom. And okay, so let's add to the pile with HBC. And I'm not making fun of this, but we have acquired a certain expertise and an ability to be able to, reposition these boxes. In only one circumstance throughout, the entire prior history of those other failed department stores, can I recall us actually demolishing a box. And this would have been a careful Laval. But otherwise,
into an apartment building.
Into an apartment building.
Yeah.
But otherwise, we've been able to find solutions because it's really important, for us as strong retail owner operators that we add to the merchandising mix of our malls, that we continue to add to that experience so that we can drive growth in traffic and growth in sales that drives our EBIT in those properties. So that's what we look first and foremost for. Having said that, it is, and you can ask this of other shopping center owners, when you do find really good solutions, it takes a fair bit of capital in order to be able to reposition those boxes. And it's not just because of the state of disrepair that we've all,
they're just big.
They're big.
Yeah.
And they're complicated. And they're big and they're complicated and they have to be modified. And especially if you're going to be accommodating, a multi-tenant use in what used to be a department store box. So look, we've had this incredible recent experience at Toronto Eaton Centre where we've just literally last week opened up the last of our 3 backfill tenants in the former Nordstrom space. So it started off with the Simons opening, a Nike flagship, and now Italy. So we've completed that. And that's going to be the first in a series of, upcoming repositionings of boxes. And we just recently announced at Pacific Center in downtown Vancouver, a over 40,000 square foot flagship store for Aritzia as part of our backfill strategy at the former Nordstrom space there. And we're in the position now of, I think, every 6 months, going to be making announcements on the Nordstrom store and Rideau and some of the HBC boxes that we've just recently gotten back. So we're working hard at it. We're incredibly confident of finding all the right solutions, but it's going to take some money.
I've said this so many times on the podcast, but I'll do it one more time. When we talk about retail, I always mention that my wife would love a gym to work out in, and then she can go and wander around. So at Sherway, if you're thinking about what to put in there, put a gym in, and you got one member I can guarantee to join that gym.
Yeah, she's also a teacher, so she's
she is actually a teacher. Yeah.
I can tell you,
there you go.
I can share with you that is definitely part of our thinking.
Yeah, sure. Yeah. Well, thanks, Sal. I think that's a wrap on this conversation. Really appreciate you coming on. It was a pleasure to spend some time with you. Very interesting insights. Thank you to Glass Lake Funding for sponsoring this episode. Of course, thanks to the forums for hosting us here. And of course, last but not least, First National for powering the podcast. And thanks again, Sal.
Oh, thank you.